For 3 years, the car market defied every rule that markets are supposed to follow. Used vehicles selling above sticker price, dealers adding markups of 5, 10, $15,000 on top of MSRP, and buyers paying them without negotiation because there was no alternative. Waiting lists for ordinary models, auction records broken month after month, a market that looked, to anyone paying attention, like it had permanently disconnected from the fundamentals that are supposed to govern how things get priced. It felt unstoppable, and for a while it was. But here is what every market cycle eventually teaches us. Bubbles do not pop when everyone expects them to. They pop when the liquidity that inflated them dries up. And right now, across wholesale auction lanes, across dealer lots that are filling up, again, across auto loan portfolios, at banks and credit unions, carrying balances that have never been higher. The warning signs are not subtle anymore. Inventory is rising. Price cuts are accelerating. Delinquencies are moving in a direction that should get everyone's attention. This is not a seasonal slowdown. This is the early stage of a structural unwind in a market that absorbed years of artificial pricing and is now beginning the painful process of returning to earth. Today, we break down exactly how we got here, what the data is saying right now, and why the correction that is forming may be more severe than most people are prepared for. To understand where we are, you have to understand how we got here, because the distortions in this market were not random. They were produced by a specific set of conditions that collided in a way that had never happened before. Starting in 2020, a semiconductor shortage began disrupting automotive manufacturing at a scale the industry had not anticipated. Chips that are embedded in virtually every modern vehicle, controlling everything from engine management to entertainment systems, became impossible to source in the quantities that assembly lines required. Factories that could build 50,000 units a month were building 15,000. Supply dropped dramatically, while demand did not drop with it. In fact, demand accelerated. Pandemic-era stimulus put significant liquidity into consumer hands at exactly the moment when vehicle supply was collapsing. Interest rates were near historic lows, making financing cheap. And a population that had been rethinking its relationship to public transit and shared transportation was simultaneously more motivated to own a personal vehicle than at any point in recent memory. Artificial scarcity met aggressive demand in a low-rate financing environment. The result was a pricing environment that had no historical precedent. Used vehicle prices in some segments increased by 40 to 60% over pre-pandemic levels. New vehicles that had never sold above MSRP in the history of their production were suddenly trading at significant premiums. The market was behaving irrationally, and it was doing so consistently, which made the irrationality feel structural rather than temporary. That is always the most dangerous moment in any bubble, when the irrational pricing has persisted long enough that participants begin treating it as the new normal. The constraints that produced those prices have reversed. Production normalized. Semiconductor supply recovered. Factories returned to full output. And simultaneously, the fleet operators and rental companies that had been forced to hold vehicles longer than they wanted because replacement inventory was unavailable began releasing those vehicles back into the market. Enterprise, Hertz, Avis, these companies had bought aggressively during the shortage and are now offloading inventory into a market whose demand profile has changed significantly. At the same time, the financing environment that made those elevated prices accessible to buyers has shifted dramatically. Interest rates that were near zero during the surge years are now substantially elevated. The monthly payment on a vehicle financed at current rates versus pandemic era rates on the same price is a materially different number. Insurance premiums have been rising, and the consumer who was flush with stimulus savings in 2021 is now dealing with depleted savings, elevated credit card balances, and in many cases resumed student loan payments that were on pause for years. The demand side of the market has softened precisely as the supply side has expanded. That combination is destabilizing. The clearest early signal of where retail prices are heading is always the wholesale market, specifically the auction lanes where dealers acquire the used inventory they put on their lots. Wholesale prices move before retail prices because they are not sticky in the same way. There is no psychological anchoring to a sticker price at auction. The vehicle sells for what the room is willing to pay on that day, and what rooms have been willing to pay has been declining. Auction price indices have been softening. Bid depth, meaning the number of active bidders competing for individual units, has been weakening. The rate at which vehicles go through auction without selling, what the industry calls the no-sell rate, has been increasing. Each of those signals means the same thing. Dealer willingness to pay for used inventory is declining because dealer confidence in their ability to retail that inventory profitably at current prices is declining. Retail pricing follows wholesale pricing with a lag, typically measured in weeks to a few months. The wholesale deterioration that has been accumulating is working its way into retail pricing right now. On dealer lots, the transformation is visible in the metrics that track inventory health. Days supply, meaning the number of days it would take to sell through current inventory at the current sales pace, has been increasing across multiple vehicle categories. In the shortage years, days supply fell to historic lows because vehicles were selling faster than they could be replenished. Now the direction has reversed. Aging inventory is building, and aging inventory is expensive for dealers because every day a vehicle sits on a lot, it is accumulating floor plan interest costs while simultaneously depreciating. Dealer incentives and price reductions, which had been essentially absent during the shortage years when dealers did not need to negotiate, are reappearing. The market is transitioning from seller-controlled to buyer-influenced, and that transition has significant implications for pricing across the board. The credit dimension of the situation is where the real systemic risk lives, and it requires specific attention because it is the factor that separates a typical market correction from something with broader financial consequences. Auto loan balances in the United States are near historic highs. During the surge years, consumers were financing vehicles at prices that had been inflated by 30, 40, 60% above their long-term fundamental value. To make those payments affordable at the time, loan terms extended dramatically. 72 and 84-month loan terms, 6 and 7 years, became normalized for vehicle purchases that historically would have been financed over 48 or 60 months. Longer terms mean lower monthly payments, which made the elevated prices feel manageable at low interest rates. They also mean that the borrower builds equity in the vehicle much more slowly, because the early years of a long-term loan are heavily weighted toward interest rather than principal reduction. The consequence of that structure is significant. If vehicle values decline by 20 to 30% from their inflated peaks, which is what a return toward pre-pandemic fundamentals would imply for many segments, a substantial portion of borrowers who purchased during the surge years will find themselves in negative equity positions. They will owe more on their vehicle than the vehicle is worth in the current market. Negative equity has specific consequences. It freezes the trade cycle because a borrower who is underwater cannot sell or trade without covering the gap between the loan balance and the market value. It eliminates refinancing options. And in cases where borrowers are already financially stressed, it increases the probability of default because the rational economic calculation of walking away from an underwater asset can become compelling. The delinquency data is already signaling the beginning of that stress. Subprime auto loan delinquencies have been rising. Subprime borrowers are the canary in the automotive credit coal mine because they feel the pressure of elevated interest rates and elevated living costs before prime borrowers do, and their delinquency trends tend to lead the broader market. When subprime delinquencies rise, repossessions follow with a lag. And when repossessions increase, those vehicles enter the wholesale auction market, adding supply and putting additional downward pressure on the prices that are already declining from the normalization of new vehicle inventory. It is a feedback loop, and feedback loops in credit markets have a tendency to accelerate beyond what initial data points would suggest. The electric vehicle segment adds another layer of pricing complexity that is compressing values in specific categories faster than the broader market is declining. Manufacturers engaged in a significant price war on new EVs, with major producers cutting prices repeatedly over a short period, creating a situation where the new vehicle price declined dramatically from the initial pricing at which early adopters purchased. The used EV market is particularly volatile because rapid technology advancement means that the battery range and feature set of a vehicle purchased 2 years ago compares unfavorably to what is available new today at a potentially lower price point. High MSRP EV segments have seen severe price compression in the used market, and that compression is affecting the overall luxury and near luxury segments of the used market because consumers who might have traded into an expensive used EV are choosing new alternatives instead. The luxury segment more broadly is showing fragility that deserves attention. High-end trucks and SUVs, which became among the most aggressively priced vehicles during the shortage years, are particularly sensitive to the financing environment because the dollar magnitude of the financing decision is larger. A consumer who is willing to finance a $65,000 truck at 3% is doing different math on that same truck at 7 or 8%. Monthly payments on large dollar vehicles at current rates represent significant household budget commitments, and as consumers become more cautious, the demand for large expensive vehicles is contracting more quickly than the demand for more modestly priced transportation. The dealer community is facing the consequences of decisions made in a completely different market environment. Dealers who acquired inventory at peak wholesale prices in 2022 and early 2023, paying at or above MSRP for used vehicles because that is what the market required, are now holding that inventory as values decline toward them. The margin that existed between acquisition cost and retail price at the time of purchase is being eroded by market depreciation before the transaction occurs. Small and mid-sized dealerships that do not have the capital cushion of large dealer groups are particularly vulnerable because they cannot absorb extended periods of margin compression the way capitalized operators can. Dealer stress in a market correction is not just a business problem for the dealers involved. It is a signal of the depth of the correction because distressed dealers become forced sellers, and forced sellers accelerate the price decline. Manufacturers are responding to weakening demand with the playbook that has always characterized an oversupplied automotive market. Cash rebates are returning after years of absence. 0% financing offers, which manufacturers can fund by effectively subsidizing the interest rate through their financing arms, are being reintroduced. Dealer cash programs, payments made by manufacturers directly to dealers to incentivize moving specific units are expanding. All of these are instruments that manufacturers deploy when consumer demand is insufficient to clear production at current pricing without assistance. The return of significant incentives is not a marketing decision. It is a demand signal. The consumer backdrop that underlies all of this is not favorable. Household savings rates that were elevated during the pandemic period have normalized downward. Credit card balances have been rising, indicating that consumers are increasingly financing current consumption with revolving credit. The resumption of student loan repayments removed a meaningful amount of discretionary cash flow from a significant portion of the consumer population. And inflation across essential categories, including housing, food, and insurance, has reduced the portion of household income available for vehicle payments. The automobile is the second largest household purchase after real estate. When the consumer is financially stressed, the auto market is one of the first places that stress becomes visible in the data. A historical reference point that gets raised in conversations about auto market corrections is always 2008, and the comparison deserves careful handling because it is both instructive and misleading if applied too directly. The 2008 automotive crisis was primarily a credit crisis. The collapse of the broader financial system eliminated the financing that auto purchases depend on, and manufacturers, including General Motors and Chrysler, faced existential financial distress as consumer demand evaporated in the context of a broader economic emergency. That specific mechanism is not what is operating today. The financial system is not in crisis. Credit is available, if expensive. Manufacturers are not facing imminent insolvency. What is operating today is a different but still consequential set of forces. Overpricing relative to fundamental value. A credit structure that extended loan terms to make inflated prices accessible and left borrowers with minimal equity buffers. A demand environment that has been weakened by elevated financing costs and consumer financial stress, and a supply environment that has normalized from artificial shortage to something approaching abundance. Price reversion in that context does not require a financial system failure to be significant. It requires only the mathematics of supply, demand, and credit to operate normally. And normal mathematics applied to the current situation implies a correction that will be felt across the borrower population, the dealer community, and the lenders who hold the auto loan portfolios. If vehicle values decline 30% from inflated peaks in the most affected segments, the negative equity implications across the outstanding loan portfolio would be substantial. Trade cycles freeze when negative equity is widespread, because the mechanism by which consumers normally move from one vehicle to the next requires positive equity to facilitate the transaction. When that mechanism freezes, it reduces new vehicle demand independently of any financing consideration. Lenders who hold portfolios of auto loans on collateral that is declining in value tighten their credit standards, which reduces the pool of qualified buyers, which further softens demand, which continues the price decline. These are not exotic theoretical risks. They are the standard mechanics of a leveraged asset market in correction. The ripple effects of a significant auto market correction extend beyond the automotive sector specifically. Automobile manufacturing is deeply embedded in the economic output of specific regions. The employment base that supports vehicle production, parts manufacturing, dealer networks, and related services represents a substantial component of economic activity in states concentrated in the industrial Midwest and in supplier communities across the country. Auto lenders which include not just the manufacturer-affiliated finance companies, but significant bank and credit union portfolios, face credit loss exposure that affects their capacity to lend across all categories. Local economies that depend on dealership employment and the tax revenue associated with vehicle transactions feel fiscal pressure when transaction volumes and margins decline. For anyone watching this market from the perspective of a potential buyer, the signals worth monitoring are specific. Wholesale auction indices that track the real-time price of used vehicles in dealer-to-dealer transactions give the earliest indication of where retail prices are heading. Days supply above 90 on specific model categories signals excess inventory that will require price movement to clear. The return and expansion of manufacturer incentives indicates where demand weakness is most acute. And delinquency data, which is published with some lag, but is tracked by auto industry analysts, indicates the trajectory of the credit stress that will produce additional supply through repossession. The timing question, whether now is the moment to buy or whether waiting produces better pricing, depends on your individual situation and the specific segment you are considering. Some categories have already corrected substantially. Others retain pricing that still reflects the distortions of the shortage years. The risk of trying to time the bottom of a declining market is catching the falling knife at the midpoint rather than the floor. Understanding the direction and the mechanism is more useful than attempting to call the precise bottom. For sellers and current owners, the relevant reality is that the peak pricing of 2021 and 2022 is not returning on a meaningful timeline. Consumers who purchased at elevated prices and are hoping to recover that value before trading are likely to be waiting for a recovery that the fundamentals of the market do not currently support. Liquidity, meaning the ability to complete a transaction and access the capital tied up in the asset, has value that should be weighed against the pride of holding out for a number that the market is moving away from. The car market does not collapse overnight. That is not how automotive cycles have ever worked historically. What happens is a sequence. It softens first. Individual segments show weakness while others appear stable. Then the softness broadens and the rate of decline accelerates. Wholesale markets tighten further. Inventory builds. Credit conditions respond to the deteriorating collateral values, and what looked like manageable normalization begins to feel like something more serious. The components of that sequence are all present right now. Wholesale prices declining, inventory building, incentives returning, credit stress in subprime portfolios rising, consumer financial capacity weakening. This is not panic, it is pattern recognition. Normalization in a leveraged market is not a gentle process. The leverage that made the inflated prices accessible to buyers is the same leverage that amplifies the correction when values move in the other direction. Watch the credit. Watch the auctions. Watch the inventory. Because when cars stop moving, the economy around them eventually stops moving with them. And the data right now is telling us that the movement is slowing in ways that are not temporary. The storm is not coming. It is already forming.